Uh, for the longest time, everyone has said the following, which is that India is a great story to be in. The economic contours are in place, but valuations is which is a concern. Could you throw more light on it? That if one is looking at projected returns from these levels, where multiples are above the historical averages, what should one expect in terms of 2 to 3 year returns?
Okay. Nikunj, obviously, this is a question which is always present for Indian market. It's not just today. If you go back 1 year, we would have the same debate. But I would say let's understand valuation from few benchmarks point of view, and that makes it easier where we are. When obviously at index level things look much more palatable, but there's excess on one side and depression on one side. But let's put some numbers in context. Like if you look at a bit of a crisis like valuation for India, that is about 11, 12, 1 year forward PE. And if you could look at 5 year average is about 19, 20 now. And if you look at a bit of a depressed valuation for India when things have really gotten bad, macro is bad and earnings have misses, we bottom out about 16, 17 the current time. We are at about 21 times, right? It's about 7-8% premium to it's 5 year average. But I would argue that India's structural investment case has risen in the last 3-4 years. Earning growth has been very resilient. One of the things we really ignore is that how uh, how reasonable the inflation expectations have been, which has been a part of problem for India. Inflation trajectory has been much more stable. GDP growth rate stands out, and also even in a context where fiscal is also consolidating, rupee is going to be stable. We don't get that context. So if there is some premium to past, it is not. I would argue that it's not a very large premium, and hence you may experience some events which impacting India's valuation a little bit, and that's the reason those phases are very shallow. So although valuation at some level has its own excesses, but at the market level, I would argue that it doesn't have as much fluff as people would imagine. So in that context, small corrections become a good window where FI flows return and market again rebounds back. So that phase we are in. We are in a volatile market. We have so many unknowns. So we expect phases of consolidation to reappear again and again. FI flows turn negative on a daily basis, for example. But at the same time, that position reverses also very quickly. And as how earnings shape up, that would shape the market, to answer your question as well. Multiples are here to stay. Multiple can expand also a bit. But I think the good part is that earning expectation that we have, for example, FY25, it's about 15 odd percent, 14, 15 odd percent. I would hazard a guess that, it's much more credible how the earnings are shaping up. So if the earning downgrade risks are lower, I would say that one could expect that multiples to rotate very easily, and at least earnings should compound into the stock returns as well.
If you like this video, then like, share and subscribe to ET Now.